Basically, there is risk involved in trading the markets, and you've got to keep that in mind. But you know, when you start talking about options and futures and leverage products, there's actually even more risk involved. And so, you know, what Larry's going to share with you is how he uses the market, how he focuses on the different markets to trade. He does a lot with weekly options, and he's going to share some of his strategies here with you today. So again, we appreciate Larry taking the time to be with us. He's not making any personal recommendations for you, but just sharing with you some general education. Now, the mission of the Trading Pub is to provide a place for our patrons where they can hang out with some of the top traders in the industry. The pub is the place to receive quality education, all while interacting with traders and investors who are just like you. Throughout the Trading Pub, we want you guys to learn from top traders in the market. We want you to enjoy your time here, and then we also try to put a focus on charitable giving as well. We are going to record this event. We'll post a copy of the recording to our website, which is tradingpub.com under the Education tab. So again, you're welcome to check back. More than likely, we'll get it up this afternoon. We'll do our best to get it up very soon, so you can review it over this weekend if you like. But again, like I said, Larry does an outstanding job when he's here with us, and we are very happy to have him back again. We will also try to post a copy of this on our Twitter account and Facebook. If you're on Facebook, I highly recommend you following us there. We hit the 13,000 mark this week, so that's exciting. We got a lot of people there and a good community of traders, and we have a breaking news feature. Some of the rules of the road: if you're going to be here, all we ask is just that you be considerate to the speaker in the room. Larry's taking time out of his trading day to be with us. I know that your time is valuable as well. That's why we do a good job of finding people that are going to share quality education, and Larry's definitely one of those guys. So if you're going to be here, be cool, enjoy your time, and make the most out of it. At this time, I'm going to turn things over to Larry. You should see a slide that says Power Cycle Trading, and that's Larry's website, also optionsontheopen.com. So Larry, at this time, you can take things away.
Hey, thank you very much, Morgan. Appreciate you letting me be here today, and thanks everybody for coming in. Got a lot to cover, so let's get started. First off, I'd like to put up the old disclaimer as well. This is purely for educational purposes today, and anything that I say as far as trades or anything are not recommendations, but just purely for educational purposes only. I'd also like to say, if you'd like to get my free ebook, it's 15 option trading strategies. Just please go to my website, powercycletrading.com, and I'll put that link here for you. See, there you go. So go there and put in your name and email address, and you'll get that ebook. It's really good. I'm also having a special for you guys today. For everybody that showed up here, appreciate your time. So I'll go through more of this in detail at the end, but it's going to be a great special, and if you're interested in it, I'll talk more about it at the end of this presentation. Also, if you're not able to, you can go to powercycletrading.com/trader and put that in, and you can get the special. I'll put that up as well. Just 1 second, I'll put that link. So there you go. So anyway, what I'm going to go over today is, first off, I'll start off, who is Power Cycle Trading? I'm going to talk about how you let trades come to you, how to let winning trades come to you, how to capitalize on a powerful trend breakouts. I'm going to talk about my favorite trading tool, which is weekly options, and why. I'm going to talk about how to get significantly higher returns using less capital. And so I'm going to get started. So who am I? I've been trading and brokering commodities and financial markets for over 30 years and began trading in the early 80s. And over 20 years ago, started trading the newly created option contracts on cargoes of crude oil, and I traded millions of barrels of these crude oil options. I went on to manage for over 10 years the International Oil Trading and Marketing Group for Transworld Oil Bermuda, which at the time was one of the largest oil trading companies in the world. And my group traded billions of dollars worth of oil, foreign exchange, financial market derivatives, and it was not uncommon for us to trade over $1 billion worth of these commodities, in a single day. So it was a great area for me to learn and experience, and it was a great part of my life. During my 30 years of professional trading, I learned a lot of different techniques that were not commonly known to or used by the individual traders, and this led me to develop a simple yet highly accurate price cycle trading system that individual traders can easily learn and use to level the playing field with the Wall Street pros. The power cycle trading model gives our traders or investors that we have an ability to recognize and capitalize on the beginning of a trend rather than getting in at the end. So I founded the Options on the Open virtual trading room where our members could improve their trading skills in a live trading environment, much like what I had when I was a professional trader. And after members asked me to teach them how to trade futures, we grew into more than just an option trading service, and hence we launched the name Power Cycle Trading earlier this year. So we've are excited about it, and I'll get started and give you guys some great strategies and really get in depth to weekly options. And today's Friday expiration, which is also a really kind of cool day for option trading. So let's get started on this journey to becoming a successful trader. First off, it's important to understand that becoming a successful trader, even a great trader, is a journey. There's no perfect trader or perfect system, but when you have a system that has a proven higher probability of success and a mentor with over 30 years of real trading experience, your journey to creating wealth will become quicker and easier. So I'm going to go through here 5 steps to let winning trades come to you. These are important, and I'm going to go step by step through this, and then we'll dive into some strategies and weekly options. As a professional trader, I've spent literally thousands of hours and dollars on trading systems, and I was paid well into the millions to analyze and implement trades for others based on various systems. So I've used and reviewed and developed many different types of trading systems, and I saw that there were 5 key elements that had to be in place regardless of the trading system. And I want to share these with you right now. First, have a plan that governs all your actions when you're trading. Secondly, be disciplined in implementing that plan. Third, learn to patiently wait for the highest probability trades based on the model that you have chosen to use or your trading methodology that you've chosen to use. Allow the trades to come to you instead of chasing the trades. 5, create structure in your trading with set goals, rules, time frames, work hours, and risk control. Make trading, if you're going to trade, make it a business, not a hobby, not something that you just pop in and out of. Have structure and focus. I mean, even if it's your swing trading or just trying to take a little bit longer term moves because you don't have time every day, be structured and disciplined of it and treat it like a business. Now these are simple guidelines, but sometimes the simplest things are the most difficult to put into action. So if you're trading a model, rules are clearly defined. That's one thing that's really great about having some type of trading model, and this makes it easier to implement those rules. So in the power cycle trading model, we have rules that are based around 4 powerful indicators to signal a price cycle change, and this is done by identifying, for our rules, defined price range. Price volatility comes into the equation, change in price cycle momentum. Now this provides set guidelines which allows the traders to come to us, or the trades to come to us. So whatever model you use, know the guidelines and rules and use them, stick to them, be disciplined about it. So the other thing is we'll use 2 to 4 different time frames for all of our trade setups and triggers. And this is a trade, what we call a confirming process, which allows for non-emotional trading. And so that's a very important factor. 90% of trading is mental, so you need to keep your emotions out of your trades. This combination has created a trading system that has on average a winning percentage of over 75%. But to achieve this, we incorporate these 5 elements that I mentioned earlier. Now the end result of using these 5 elements in your trading is that you make decisions based on the model that you're using or your trading methodology, not the emotions of fear and greed that often sabotage your trades, leading you to overtrade or give back profits. And that's a big problem. I mean, I'm constantly working with myself not to overtrade. That's the biggest problem that I have in trading is to overtrade. So I try to be very selective with the trading model that we use. So I'm going to start off here with how to capitalize on powerful trend breakouts. And this is something that you guys can, start with today after we get off and start practicing this. You'll probably get a couple of good trades depending on the time frames that you're looking at. So to do breakout trades, we will incorporate moving averages and trend lines for breakout trades and trade management. In this little presentation I'm going to do, I'm just going to stick with trend lines, but we also incorporate into our trading model and methodology the combination of trend lines and moving averages, plus those other 4 elements that I showed you earlier. So trend lines. I'm going to show you the correct way to draw them. I'm sure everybody's maybe looked at trend lines, used trend lines in the past, but there's a way to draw them, and if you do it this way each and every time, you will make it mechanical and you'll make it systematic, and that's what you want. You want a system. You want to make everything systematized and disciplined the same over and over and over. So supply and demand dictate price movement and the use of trend lines. Trend lines are universally used, but the construction of them can be very dissimilar from one person to the next, causing for a very subjective interpretation of a trend line. And you don't want that. You want it to be precise, the same each and every time. So the difficulty when creating these lines involves specific points you select to connect, the lines. Human nature often interferes in the proper construction of these type of lines. We are accustomed to reviewing historical price activity of a market from the past with dates reading from the left of the chart to the right. And as a result of this, the demand and supply lines that you will draw a trend line are extended from the left side of your chart to the right. Now, intuitively, this is the incorrect way to do it because recent price activity is more significant when you're trading than historical movement. So precision and accuracy demand that the lines be extended from right to left with the most recent date appearing on the right side of the chart. So I'm going to go through several really great examples so this becomes very clear to you, and then you can practice this and take it, after we finish here today and try to use it, incorporate it with what you're doing. Basically, supply trend line is the declining price movement as defined by a downsloping line, as well as the pattern of both lower price highs and lows. So we use supply pivot point as when there is a price high that is not exceeded by the prior price or price immediately thereafter, and this is a pivot high. So this is the definition of the rules that I put in place to draw my trend lines. And these are so specific you could even code these or program them into your system. So this first chart I'm going to show you here with this drawing tool. What you want to do is, like I said, you don't want to go from past price, left of your chart, to the right. You want to go from current price, right, to the most current price. So if we look here, if I had this in time, you would not see this information up here, right? So I'm going to look for the most recent price. So I'm going to be looking at the chart, and I'm going to look for a pivot high. So this is an example of a descending supply trend line. So right here, pivot high 1, that arrow. If you look here, here's a pivot high, and that's defined by the price bar before it being lower, price bar after it being lower. So this is your first point. There's no other point down here. So this is your first point from most recent price. Then you go to the left. You start going up to find that next point. Here's your second point right there. It's higher than the bar prior, and it's higher than the bar after. So then what you do is you just take that point with your drawing tool, extend it, and then draw it down. And you have a perfect trend line. You can draw it the same way every time. You're not going to draw it from this high. Some people, take the body of the bar and they, draw it like this. or they might take that high bar there and they draw it like this. So look at the difference. And this is not accurate. So if you take it from recent to past and do that each and every time, you're going to have a great tool to use for your trading. I'm going to go through some other examples here. This is gold. Now let me point something else out to you before we move on. These arrows here, this is actually where our system that we use went long. So what I love to see is when my trading model gives me a long signal in this example, and then I have my trend line here, I'm very comfortable and confident that I might get a potential for a big breakout. And then I also incorporate some moving averages, which I'll go through at another time. So here's another example. Here's gold. This is the gold futures. We had a price cycle low buy signal for our system. And then if you look here, here's a pivot high right here. Oh, sorry. Here's a pivot high right there. See that? Higher than the before and after. Then go up here to that one. Draw your line. Boom. Break out to the upside. Look at that powerful break. So we have a system, says go long, I have a trend line, I'm really all over these type trades. Here's another example of Amazon. Our system went long here, I have a pivot high here, draw my line, measure the upside. So you can do this on any time frame. This was taken yesterday, these were some trades yesterday on Apple. Here's a 400 tick bar, so you can see how you can use it across whatever time frame. Here's our system went long here. This was about 12:14 Central yesterday morning, or yesterday midday. Here's a pivot high right there. Pivot high, draw my trend line. I saw my price signal here, so I'm into this thing looking for a trend break to the upside and got it. So the opposite is the demand pivot points or the demand line, and this is the where you have a lower price that is lower than the prior price and the price immediately after. And this is what I call, or we call, the pivot low. So here's an example of pivot low. Here's your demand line going up. Okay, so we draw that by coming in from, right to left, not left to right. We look for the first most current price, which is right here. So this low is lower than the bar before and lower than the bar after. So I go down to find the next low. These are not lows. You see here, this is not actually, when I looked at it, this low was not lower than that low. So I had to go all the way down here to the bottom here, and I got this pivot low here. So then I drew my line, extended it up. Also had our model is really in sync with these things, so I had a short sell there, trend line break there, down she goes. Now what I like to do, and I'm going to give you one more pointer, I also like to incorporate moving averages with our model. So we have our 4-step model. It gave me a short signal here. I got a trend line here. I've got a moving average here. So what I like to do is I'll show you. When you're playing trend line breaks, you want to give it a little space. You want to, like right here, see if you had shorted this thing right when it broke. Look at the tail on this candle. See that? You could have gotten stopped right back out. So what I like to do is, if you get a break and here's your moving average right there. I'm not sure. We use a couple set moving averages for everything we use. So in this one, I think this is the 15 EMA. So what I like to do is give it some space. I'm short here. We had a couple of short entries. I would have taken a short here, and then I look to add on here. But what I'm going to do is wait. I'm going to give it some space to break that trend line and break that moving average so I don't get this bounce back in my face, this tail. So if you give it a little space, so you look down here, at some of these other lows, so you can see the trend line break. Now if you don't have another moving average until down here, then I call this whole area in here open prairie. So it gives you a focus that you can see a huge move to the downside. So this break here, you can see that the next level of support really wasn't until you got to about 135. So it broke here about 135.50, 135.40, and then you had 50 cents straight down, and then it broke there and went down another. So I like to give it a little room and then get in so I don't get this bounce back. So that's a example there. And here's Apple again yesterday, and this is on a 400 tick bar. This was yesterday, the 18th. You can see here pivot low, trend line, signal that we got came in here, broke the trend line, give it some space right here. Down she goes. That went down from, big move down. That was a great short yesterday. I'll show you this on a little bit later. So it, went down from 638.50. There was nothing else down here. There are no other moving averages, and didn't stop until 636. So, $2 straight down. So see, you can afford, if you're trading something with a big enough range, you can afford to give it a little space, and you don't have to jump right on it. You give it a little space first. So that's trend lines. Now, I'm going to go into weekly options here, and there's a lot to cover, so I'll try to get as much in as I can. So my favorite thing, I like at Power Cycle Trading, we incorporate futures and weekly options. So a lot of our members will trade futures, which have a lot, and a lot of the members will trade weekly options. And specifically, we'll trade a lot of Apple options because they have a tremendous price range each and every day, great liquidity, great depth to it, real tight bid offer spread. So, it's the perfect thing. And Apple trades like a futures contract anyway. So I'm going to go through the benefits, then I'll go through some of the nuts and bolts of these options, and then I'll go through some strategy examples. So when day trading or swing trading stocks, I like to use weeklies, which offer exceptional trading benefits. One of the big benefits is what I call leverage at a low cost. So I'm going to start off with an example of results that we've had, that we've gotten out of using weekly options in our virtual trading room. Now these are unaudited trading results of actual trades taken by me and called out to members in our room. And this was out of the options on the open virtual trading room. But again, there's no guarantee that, to have future results that are good or anything close. So this will just give you an example. You look at the cumulative return, you look at huge returns, 400, 800, 900, you think that's crazy, it's impossible. But I'll show you today it's not. So I just wanted to show you this to show you how big the cumulative returns can be. And, we've had a really great winning percentage too based on our system model and the way that the trading methodology that I teach our members. So let's dive into some facts here about the weeklies. Weeklies now account for nearly 12% of the 300 million option contracts traded every month. Weeklies are still a relatively new contract, but should not be overlooked, for they offer huge trading benefits. And if you know how to use them, you'll get those benefits. For some of the more exciting stocks like Apple and Google, weeklies now make up a whopping 40% of all option volume traded. And we, were involved with Google yesterday, and I'll show you some of the results of that here a little bit later. The new options are available each Thursday and expire the next Friday, 8 days later. Weeklies are cheap. Since their expiration is within days and often hours, you can purchase at-the-money weeklies for as little as $5 to $10 per contract. I'll show you an example of that a little bit later here as well. They have unlimited profit potential. They can move as much as 500 to 1,000% and even higher. I've seen them move much higher than 1,000% actually. And this can be done on, on a fairly regular basis. It's not easy to find these, but they do happen, and occasionally, you can find one that you can get into. Weeklies are easily traded securities, and when I come back to this, you might not catch one that gives you 500, 800, 1,000, but they're there. But you might get 5%, 10%, 20%, 30%, or 100% pretty fast. They're easily traded securities. They trade just like stocks. The volume is very high, especially on Apple, so it's not any problem to trade them. So I always tell our members from my trading experience that if it moves, you can trade it. And so if it's a number and it has data, you can trade it. Weeklies will bring in more low-risk income. Weekly options give you 52 times a year to profit from low-risk, non-directional and directional income strategies. So that's 40 more opportunities than you would get from just trading a regular option contract. Weeklies are for everyone and not just the pros. Options have managed to get a bad rep over the years, despite being used by practically every professional investor out there. And this is because education offered on options is sometimes a lot too difficult and complex that new traders are simply overwhelmed. You know, when you get into the nuts and bolts of the math and the Greeks and all that stuff, it can be very complicated. But I use what I call the practical way of trading options to teach option trading, and this focuses on really two major points. And that first thing is the option delta, and then the second part is the market timing. Market timing is the single most important factor in assessing a stock's likely price movement, in my opinion. Traders realize that the importance of market timing, but a lot of times just don't have what they need to get this information quickly and accurately. And I kid our members that we have an almost unfair advantage because we have both a high probability trading system and the knowledge of how to use weekly options, giving us a great trading advantage. Now, this is this actually I did this today. So this was this morning before I came in here. I just want to show you an example. And this is the actual option contract, a chart of it. This is the 630 puts on Apple that expired today. And so based on our trading system, our model, I got long and I called this trade out to the room. This came at about 8:36 Central, right here, this arrow. So I got long the 630 puts right there. You know, Apple was coming off hard. It had broken or was going down to the 100-day moving average. So I liked the trade, got in here, and within 4 minutes I was out up here, and I made $100 a contract. So Apple went from 365. I got into that trade at $365 a contract. 4 minutes later, I got out at $465 a contract. That's $100. If you take that 100 over the cost of my capital, my cost of my contract, 365, that trade in 4 minutes made me over 27% return. So that's the power of weekly options, and a lot of that is because the weeklies, that was like a 50 delta, and I'll go through that a little bit, but the volatility starts to erode, and then time decay, time value is down to 0, so you can get these options cheap. So this is some other examples. This is yesterday trading, and these were trades I called out to our room yesterday on the 18th. These are, again, all Apple weeklies, but to illustrate the cost and your return on capital, this was yesterday. So I had these trades. That was a scratch. The second trade was a short, 640 puts. I bought it. One contract, remember, equals 100 shares. So this one contract was $440. I sold it at $545. I made $105 a contract. 105 over the cost of my capital, cost of my contract. That was over 23% return. The next trade, scratch. The next trade, I bought the 640 calls, $380, got out at 440, made $60 contract, over 15% return. The last trade of the day, another short. I bought the contracts for $500, got out, a couple minutes later, 540, 8% return. So that's, you can see how that cumulative, see for the day the cumulative was 52%. So you can see how that cumulative adds up. So that other chart that I showed you with those cumulative results, that's how you get them. One day you might make 52%, or one day you might make 5%, or one day you might lose. But you can make these kind of returns on a regular basis if you're trading the weeklies. So here's just a chart of those trades yesterday. This again was right on the open. Most of my trades come in the first 30, 45 minutes, and then I'm done for the day. So here's a short, went neutral, long, went neutral, short, went neutral, short, went neutral. Those were those trades I just showed you. So what we're going to look at now, we're just going to look at some of the basics of weekly options, the valuation of them and how they work, just the internals, so you can also see with a clearer picture, what it looks like. Okay, right now I got a question. The delta, the spread is 15 to 20 cents. That can become common because today's the expiration day, right? So the spreads can get a little wider. But what you want to do, and what I do, is I'll go I'll take the go out of the money a little bit more, and as you go out of the money, getting a lower delta, the spreads will tighten. And that's one great thing when you trade Apple. It has such a big price range that you can, a lot of times if you get the direction exactly right, you can go with the lower delta on the option. You get really tight spreads that way. The deeper in the money, the higher delta, the wider the spreads get. It's just a matter of liquidity. If you look at the volume trading, most of the volume will be trading around the 50 delta, so those spreads are going to be tighter. And the other thing is that on Friday, those spreads are going to be wider because it's the last day, so keep that in mind. It's not difficult at all to close a trade on Apple, or most anything. If it's a price that moves, there's a market, so not difficult at all. Okay, so the value of an option, if just to go through, is time value times implied volatility times intrinsic value. And by using options, weekly options for day trading or swing tradings, we've been able to better utilize their beneficial factors of time decay, the volatility, and the option delta. And this has created a forceful, like triple win trading formula for us. Then by combining our directional price cycle breakout system, we have created a really great high probability trading methodology. So that trend line breakouts, that's what you're looking for on, you're looking for breakouts on Friday expiration. You want something that can explode up or down if you're going to take go long premium, because you want to take advantage of really a cheap premium, and I'll show you that in the next example to take advantage of that. But anyway, here's another graph. Here's time decay for a weekly option. So here we start on a Thursday, right? So we have 100% time, and then as you go through to your 8 days of expiration, as you get to expiration, it goes to 0. So basically the value decreases by 1/8 every day, or roughly 12–13% until it goes to 0. So here's the table the math works out. So if you look at Thursday, you've got time value, implied volatility, intrinsic equals your price or value. So on Thursday, you start out at 1. I put in these implied volatilities just to illustrate the example. Yeah, I sell weekly options too. And I'll show you an example of that in a second. So 1 times 300 implied vol, keep the intrinsic at 1, equals 300. So I just want to show you how time decay affects these things. So if you look here, here's 1, then it decreases by 1/8, 1/8, 1/8. So, when you get to Monday, you've got that value is down at 0.50. And look, I put the implied volatility at 800, kept the intrinsic at 1, and you barely moved the premium. The value of the option barely went up because of the time decay. Look, Tuesday it's 0.38, 500 vol. Look how much it dropped. So that's what you have to be able to benefit from. If you don't know how to use weeklies to benefit with the time decay, you'll never make money. So I'm going to go through some examples to give you some ideas. So here's just another example to illustrate the power of the weeklies. So I'm just going to take this. This is an Apple option chain. This top one right here is the weekly option chain. The bottom is the monthly for Apple. These were at the Apple at the time was trading about $632 per share. So, I just took an example here. I took the delta. There's the delta column here. So I went with we usually go with the 50, 60. We usually go with the delta anywhere from 40 to 60 because of the cost. And if you get a 50 delta around there, Apple moves so much you can still make some good money. So you can see here on the 640 strike right there that Apple was trading at 505. So that's a $5 spread, and that means the bid is $500, the ask is 505. Now if you come down to the option chain below here, go to the exact same strike, 640, 55 delta right there. The cost of this contract is $10.50 at 10.60, so that's $1,050 a contract bid, $1,060 ask. So you can see it's double the price of the weekly up here versus the monthly. So you can see that time value, that's the real difference in here is mostly time value, and then you do start getting volatility, decay, decreasing, especially that last day when it has to go to 0. So that's the power of it. You can see it illustrated right there. Now this is just a table to lay this out so you can see the numbers correlated with it. So if you took an Apple and you just bought the shares, and let's say it's $640, it's trading at that. So to be equivalent to one option contract, you buy 100 shares, right? So that would cost you $64,000. And Apple will move into spurts of $1, $2, $3 at a time. So let's say you made $1. That's pretty easy on Apple. It usually moves in dollar increments. So that's $100 a share. So your return on capital was 0.16. So it was way less than 1%. Now, if you instead of buying shares, you bought the weekly options with the 50 delta, 5 days till expiration on this example. So that contract was $500 for one contract. $500. You made $1, so that's $100 because of one contract. Your return on capital is 20%. So you can see the huge increase. Now, if you just done the monthlies down here, that was $1,050 per contract. You made $1 or $100. Your return is 9.52%. So you can see the difference by using options, much greater return. By using weeklies, double that return. So on Friday, there are several different strategies that we can use. One of them is the advanced directional strategy, and the other is volatility collapse income strategy, because volatility goes to zero, so you want to take advantage of that. So it's volatility collapse. So what we'll do, and I'm going to try to get through all this because I want you to get an idea of screening. So what we're looking for are stocks that are susceptible to a short squeeze. That's a really great setup if you can find. Are looking for stocks that may break up or down based on some trend line breakout analysis. And we will use our power cycle trading model, for all entries. And then we also look at what we call pinning analysis, and this is done on all the stocks or ETFs that we consider for trading. So another resource that you might check into if you're interested in these kind of plays is highshortinterest.com. You can find the various stocks that might be way over shorted and low float, and then you can find stuff that might be susceptible to a big breakout. And those are the kind of plays that on Friday, if they do break out, you can get these huge. So the first thing that we will do is, if we have a candidate we're looking at for a trade, we'll do a strike pinning analysis, and we'll do this usually on a Thursday and then on Friday. And so basically the way it works is you go in and you get your option chain, and you look for the formula that I use is right down here is total call open interest plus daily call volume plus put open interest plus put daily volume. Now I'll do this on Thursday, like in the last 10, 20, 30 minutes, so I get what it's looking like the day before expiration, and then I do it on Friday's option expiration day. So what this does, it gives you a statistical overview to identify strikes that, with the most activity. And then on expiration, there's a high probability that the market will push price towards the most active strike price by close of expiration. There's so many different market forces in play, and this information really highlights the area of activity, so you can kind of focus in and develop trade strategies based on what you're seeing there. So here's an example. Here's Apple option chain, and if you look here, this column right here, here's your open interest, here's your volume on the day, and over here is your put volume, put open interest. So I just go through here, and right here you can see big open interest here for the 670 call, and then for the puts, the big open interest is down here at the 650 put. So if I look at this, eyeball it, I'm going to say Apple's going to close someplace below around 670 to 650. It's a wide range, but you can use that range to take advantage of different strategies. And then I'll take the volume, I'll total that up all the way across, and the one with the most volume is the one that I'll kind of look at. So on this particular example, showed the open interest volume was skewed to the calls. There was more open interest. If you look at this real quick, this is another thing to look for. See the open interest and the volume. Well, the open interest was much greater on the calls than on the puts. So it tells you that the market's more interested in this stock to go higher. So even if you don't trade options, it's a good way to get an idea of maybe where the stock might go. So, and then the calls with the most total volume building at that time were the 665. So I just did that volume count. I just did the call open interest, added that to the call volume, to the put volume, to the put open interest. Total volume was 173.78. So the 665 was a real big area of interest. So then how do you use this? So, and I'm going to show you a couple examples. But first one was that the call volume skew. It indicates potential for a bullish close towards the 665, 670 call strike, because you could see all that volume stacking up at 665 and 670 plus the open interest. So it gives you a good clue that there's more high probability that it's going to go gravitate to 665 than 670 and 670. So here's an example. So this is, let's see. Here, this is a first example I'm going to show you is a directional strategy for, and this one was based on Netflix, an actual trade there, and this is Netflix. So what we're looking at here is a daily chart, and here's your trend line right there. Draw your trend line down. My power cycle model gave us a long here, so we had a trend line break. So we're looking for an option trade setup. That, we're looking pre-market, saw this. So okay, let's look at Netflix. Netflix always usually overshorted. So then this is 30-minute chart. This is 16th of March. Here, look, see pivot high, trend line, cycle model went long, boom, up she goes. So here's the trade. So this was bought to open on March 16th. The options were expiring that day. This is a 110 call. They were going for $11 a contract, $11. So the 110 call, it went up to $174 a contract. It closed at 127. If you'd bought these at 11, and let's say you sold them at 127, your net gain was $116 per contract. That's over 1,000% return on your capital. So that's how that works. So here's a chart of that again. This type trade came at, you can see here, at 12 o'clock. Usually it's going to happen, there are two parts of the day. In the morning, I will trade the first 30 minutes buying premium, but then after about the first half of the day, then I usually will, unless I get the directional play like this exactly right, I'll usually sell premium because volatility collapses and go to zero. So it's usually the second half of the day where you see these explosive moves that really catch people off. So, from like 12 to 1:30, you might see a really explosive move. So here's the 10-minute chart of Netflix. You can see this was around 11:30 or so, and see it just shot straight up. Now here were the options. They were over on this chart. They were at 11 cents. That's $11. So, you can see how it stayed here at 11. It got up to 20. So you could have bought a low of 11 to 20 to 15 cents, and then look, it exploded. It got squeezed, and it went all the way up to $175 and closed out, down here about 127. So that was the 110 calls right there. So you can see this is a graphic example of that trade. Now the next one I'll go through just to show you. This is a volatility collapse, and this is where you sell premium because volatility goes to zero on expiration. So, basically if you're familiar with options, kind of going fast through here because I want to get this in, but your volatility goes to zero, so you want to take advantage of that. So in order to do that, you sell vol, so you sell premium, right? So you either sell calls or you sell puts, and then you take advantage of the collapse and it'll go to zero. And the highest probability for maximum profit occurs when a put strike chosen to short is at the money or in the money, and is out of the money at close of expiration. So you get the biggest premium, right, when you have those 50 delta in the money delta. And so one thing about when you're selling options, it's just a margin put up, and margin is not really margin is collateral, not a cost. It's simply a deposit made with funds from one's account, and it's known as margin. So your return on your margin, I mean, if you look at it in its only collateral, your return is really infinite. So I thought that's kind of cool. So here's a volatility collapse income strategy. This one was on Apple on about August 31st. So here was Apple, that option chain that I showed you earlier. Here's the 665 strike right here and the 670 strike. You can see all the open interest is skewed. It's pretty high there, 16,000. Much higher than on the put side. Big volume at the 665 and the 670. So that's giving you some clues there. So, gives you some trading opportunities. So here was Apple on that day. Apple didn't hardly even move that day, but I'll show you what happened if you shorted vol on that day and shorted puts for a volatility collapse. So here's another chart. This is of Apple. This is a 400 tick chart, and this is the let's see, right here, Apple was trading at about 1 o'clock. That's where it started to take off, and then it broke a trend line here. You can see it moved up and it broke another trend line here. So you had a couple of different really great trend line breakout trades here, and I'll show you the one that set up nicely. So this is the Apple 670 puts, and this is a 15-minute chart. This is the actual 670 puts. So instead of buying to go long when Apple made its move up, if you'd sold the 670 puts here, you could have collected $8 or $800 a contract. It closed in the money. It closed down here, at 665 or below. So that's in the money. You would have to close out this trade because otherwise you would come in and you'd be, have this put to you. You would be long. If you didn't want to be long, you close it out, and you would have closed it out at $4. So you sold it for $800, bought it back at $4. You made $400. Now here's the 665 put. At the same point in time, you could have sold those, collected $300 per contract, and it expired worthless because it was out of the money at close. And so this is what it would look like if you'd done that trade. So this is your return. So if you'd sold the 670 puts, which expired in the money, you'd have to cover those. So you received $800 in premium. You covered back at $475. So you were, at a flat on the day. Your gross profit was $325 per contract. Your return on capital out, that's a 68% return. Now, if you'd shorted the 665 puts, they expired worthless. Your premium received was $300 per contract, and they expired worthless, so you kept the whole premium. So you made a 100% return. So in summary, the dynamics of these short duration weeklies, offer exceptional trading benefits. They offer you the ability to make money with lower risk, low capital requirements, short time frame for trading, higher profits, higher returns, and weekly trading opportunities. To cover back, you just buy it back. You're short, right? So you just buy back that option. So you shorted this on that one example. You shorted the 670 or 675 puts. You collected $800. So you just buy that put back. You just trade it like you would the share. So if you go short shares, you're going to buy them back, right? Same thing with options. So on that particular one, you're short puts, which means you're going long, and then you want to cover it back. You're just taking advantage of that option decay and option volatility going to zero. The risk of selling options, well, in theory, there's infinite risk because you're short, right? So if you short a share of stock, your risk is infinite, right? It could go up and up and up. But you use, stops just like you do with anything that you sell short. So you have a risk management procedure set up, and you use those to take advantage of, your risk management rules. So when I short calls or I short puts, I just treat that as like I would treat an underline if I was short Apple or short Google or whatever it might be. I'm looking to buy back that short. Well, when you're selling options, you're naked. If you're doing if you're doing a volatility collapse strategy, you are naked. Now, there's some other ways to take advantage of doing it to short volatility, and that's by shorting a spread. So you're short a leg and long a leg under it. So, you could do a bull put credit spread, or you could do a bear call credit spread. That way you take advantage of selling premium, but you're, minimizing your risk based on having a spread. Chipotle Mexican Grill, I saw that. That was fantastic, kind of down $35. How would I play that? I would look to, well, the way I'm going to actually probably look at that is I will look for it to start showing a bottoming. With the volatility collapse, it's blown out the volatility on Chipotle. So I'll be looking at my trading model and looking at the charts, and I'll look for it to, when it starting to bottom, then what I'll probably look to do is, yesterday you had the options come out for expiring next Friday. So say on Monday, Tuesday, if things look to be stabilizing a little bit, I might look to put on a bull put credit spread, credit spread below the market. So if Chipotle is trading at $200, I might look at the 150 puts and maybe sell 150, buy the 140 or 130 puts below it, something like that. I like to give myself enough room to the downside where I don't have to worry too much. I'm not going to sell something very close to the money because it could keep going down, but I'm just happy to take something out of it. So, if you can still get some pretty big premium because the vols jumped up, then that's the kind of position I would look at. Or you could do, you could do a bull put credit spread, or you might do an iron condor. You sell the bull put credit spread as it's going down, and then if it takes a move back up, you might sell the out of the money call credit spread. So you do an iron condor. So those are great, trading strategies to take advantage of premium. Yeah, you could look at your standard. I would look at 2 standard deviations at least for something like Chipotle Mexican Grill. I mean, if you look at Google yesterday, I don't know how many standard deviations that thing went down. I should have looked at that, but I didn't. It was probably down 3 to 4 standard deviations when it took that $60 plunge. The Apple Pen today, we were looking at anywhere 620 to 630, 635. So I don't have my option chains up right now, but that's kind of the area that we were looking at. And it was right there at that 100-day moving average, so it kept breaking that 100-day, which came in about 626, 23. So I was thinking it would at least test down to 625. I'm not sure where it is right now. So I was thinking it's test down at 625, and it could break that, go to 620, or then it could hold and then go back up to 635. It'll suck everybody in and then go the opposite way to give max pain, right? So just to cap things off, appreciate you guys being here. And is it right now? It's at 617. Wow, so good. So it went down at 620. That was where the most of the open interest. There was a lot of open interest there on the puts. So that's not surprising. I wish I was there being short. But anyway, I'm here with you guys. Hopefully you'll take home some good trading strategies here, and you can go and apply them to your trading after we get out of here. But anyway, this was one of my members yesterday, Doug. He had a great day. He was actually into Google, and he said because of your coaching, I stayed out of what falsely looked like great trade setups because the spreads were so wide. And as you coach, I waited for the trade to come to me. Always let the trade come to you. Don't chase it. On Google, this is he did 3 trades that afternoon. He made $100, $30, and $20 using weekly options, and that's a huge return on his capital. This took him all of 10 minutes. So he said options on the open is the best money that I've ever spent, and for educational purposes. And that was yesterday. He sent me this email after the close. And then I have lots of testimonies if you'd like to go look. But this was another member. He said, Larry's methodology is the most clear-cut and logical for me to understand and is so universally applicable across instruments, I could not be more satisfied. And then he followed up, a couple of weeks later, he said, I want to restate how pleased I am with the basket of indicators you have developed. He's trading the ES minis, and he trades regular hours and Globex, and he's very pleased. So if you'd like to take advantage of what these guys did, you can get today I'm having a special for you where you get a choice of any of the power cycle trading courses. We have three. One is power cycle day trading for futures. One is power cycle day trading, which we use for stocks or ETFs, and you can use for your options. And the other one is power cycle trading, which is for longer term swing trades or longer term trades. These courses are $6.97 each, so you get a choice of either any course that you want. Then you get my option trading made simple, which is a real easy way to determine option delta. And then we just started a new service called the Daily Aftermarket Power Outlook. And this comes out every day after the market close. It gives you an update on the market, advanced, like what we're looking at the next day, any swing trade ideas. So it's perfect for those that can't be in a trading room all day trading. So it gives you, if I see a great swing trade, I'm going to comment on that. So this comes out every day, 5 days a week, and you get 2 months of that free. It's $99 a month, but it's for free for the 2 months. And then you get 2 months in our virtual trading room, which is valued at $294. So you get all that, and I'll put the link again down there. You get all that for, which is a value of over $1,300 for $697. And this is for a limited time for you guys that are here today. And let's see, the link I just put up, but it's powercycletrading.com/trader. So if you're interested, please go there. I'd love to see you in our trading room. When you're in our trading room, it's $147 after your free time's over. The trading model that we use can work on any platform. I'm a Ninja partner, so it works with Ninja Trader, Thinkorswim, TradeStation, whatever. I've got a lot of different great stuff with Thinkorswim. We've got one of my members now is coaching with me. He's a PhD in neuroscience, and he's also a technical genius, but he's put together all these coded stuff for Thinkorswim, which is fantastic. So we have that available as well. Well, we have a lot. Yeah, we have several different Canadian members. Yes, we do. But these courses here, you can see them outlined. Power Cycle Day Trading, 137 page manual, 13 videos. The Power Cycle Day Trading course, 109 pages, 20 videos. Power Cycle Trading, 64 pages, 17. And then Option Trading Made Simple. And so it's a great package, and it'll get you moving, to help your trading and get you headed in the right direction. And then I'm in the trading room from 8 every morning Central till 10:30 or 11, teaching, giving you trade setups that I'm taking, and coaching the whole time. We don't use Ninja. A lot of our members use Ninja just for the futures. So yeah, I'm constantly adding new videos. When I update the system, that's always free to the members that have purchased it. As long as you're a member, you always get any updates for free. We have, let's see, our Canadian members. Gosh, I can't recall what platform, but we have several Canadian members, and they're using either Option Express. I'd have to go back and check, but we have several members in Canada. So I really appreciate everybody being here today, and if you have any questions at all, please email me, support@powercycletrading.com, support@powercycletrading.com. Interactive brokers, yeah, that sounds right. Thanks, Morgan. So again, thanks for your time, Morgan. Appreciate you letting me be here today, and good luck with everybody's trading. Try those trend lines out with your trading, and look at those weekly options. I think you'll get a lot of power out of them. Thanks very much.
All right, great. Thank you, Larry. That was an excellent job as usual. John, I'm not sure, you'll have to send Larry an email for that, support@powercycletrading.com if you can. We'll post a copy of this recording. I hope to have it up very soon, and we'll get a copy of that posted for you. But we appreciate everybody taking the time to be with us today. Hope that you have an excellent weekend, and again, we'll get a copy of it posted on our website at tradingpub.com under free education. So thanks again to Larry for being here, and be sure to take him up on his offer. It's Power Cycle Trading. I'll type in that link again as an announcement. You can just click on this link right here. It should pop up on your screen if you have any questions. But again, Larry does an outstanding job. We really appreciate you taking your time today on a busy options expiration day and sharing that with us. So hope everybody has a wonderful